Welcome, everyone, to Daily Bread with Tom Hartman. I am here to speak to you about markets and macro and dollars and equities. Why? Because as a retail trader, I care about making money and I care about you making money too. It's not a lot of options available to us millennials as we move into the fourth turning, into the next first turning. Things are going to change, things are going to be dramatic, and we need to be prepared for it. And the only way to do that is to share the knowledge that we have with each other. So that's what Daily Bread is here for. Every day from Monday to Thursday, we go over what's moving markets and what we need to pay attention to. And if there's any big bets, I'll point those out. If there's any big dangers, I'll point that out. Sunday Fuel, every Sunday, we around 6 o'clock, me and my brother Bad Guru, we talk about the setups, the trades that could happen during the week for NASDAQ, for S&P, for Bitcoin. These are specific trades. But here, we're going to talk about macro effects. Now, for this week, we've been talking about the negative gamma spirit bomb. That's right. For you Dragon Ball fans, you already know what I'm going to be talking about. But if you're not interested in anime or anything like that, short recap here. There are dynamics within the markets right now that we haven't seen ever before. And we might end up in a perfect storm type situation that could end up really completely obliterating markets, either to the upside or the downside or both. And it's what keeps me up at night. And since we saw Bitcoin hit $89,900 over the last couple of days, now I'm starting to open up the Pandora's box to see what's inside. Could we really be setting up for a type of situation where we see limit down in markets day after day after day because of people coming together in a GameStop-esque type move to actually drive markets down or up or sideways violently? Yesterday, we talked about Michael Green and his views on passive investment flows. He is not the only one who speaks about this, but he is the most eloquent. And he talks about the idea of passive investment flows where there's these forced buyers within the markets, people who are, their money goes into a 401k, goes into target date funds, goes into certain types of assets, and it just buys high performing assets, which causes markets to go up and to the right. And at the time, this was 3 years ago, he was talking about how passive investment flows now account for about 45% of markets. And now it's even more than that. And the active money managers, they're mostly selling out of the market and then trying to get back in when valuations are that much higher. All-time highs and all-time highs keep coming. And that type of effect can turn negative. You can have all-time lows, so to speak, that happen as the workforce gets decimated, as the unemployment rate goes up, and as people become forced sellers of their assets, right? So first they selling stocks and whatever assets they own in order to get money because they don't have it. And two, with the unemployment rate going up, the number of forced buyers decreases as well. And this could only be, I imagine, exacerbated with the advent of AI and robotics, because these systems, as I might imagine, aren't going to have 401ks. So let's see what happens there. Today, I want to touch on the idea of the instrument of our demise, and that is zero DTEs. This is a type of option that is has 0 days to expiry. That means you buy it that day and expires that night. The smallest of all options, the smallest of all units, is the cheapest, but comes with a big potential upside and or downside. Basically, the power of zero DT options is that if you get the right one and they move in your direction when you expect it to, it could be a massive upside to you, either if you take a long position or a short position. I was just going to say long calls or short calls. But there are people on the other side of that trade, the market makers, the dealers, who are selling those assets. And in order to hedge, well, they can't hedge like they normally do. These are zero dated options. But let's not take my word for it. I'm not an expert in the field. I want to go ahead and listen to Kem Carson, who's the one who's really brought this to our attention some years ago after the whole GameStop fiasco. And has just let us know here that if There's a doomsday scenario in which markets get violently moved in a particular direction because of a group of traders, massive group of traders, Wall Street bet type traders who, or hedge funds or what have you, who use the zero dated DTEs and the hedging mechanisms of market makers in order to cause problems and profit for them. But let's see what Kim Carson has to say here from Kai Volatility on one of my favorite podcasts, Excess Returns.
A lot since we last talked to you, this zero DTE options idea. When we last talked to you, it was a thing, but it was not the thing that it is right now. It's risen a lot. And I'm wondering if we could just get your take on that as well. I mean, do you see that as a big risk to the market? I mean, it seems like as an outsider, like the use of those has gone up dramatically. Do you see some sort of major risk to the market associated with that?
So it's nuanced, right? Everybody wants black or white, right? And it's nuanced. In some ways, it's better, less risky. In other ways, it's significantly more risky. Let's talk about how. Let's start with the why it's less risky first, because that's like the less the conversation people aren't having. If you look at what happened with derivatives in the past, in terms of causing major issues, it tends to be there's a liquidity imbalance, right? Somebody gets short. Think long-term capital management. What are the first two words there, or the first word there? Long-term, right? The opposite of zero DT. Why was long-term capital management a problem? Because they were selling vol 1, 2, 3 years out. And when they had to come back and buy it, they couldn't wait, right, till it expired. They couldn't wait till it went away. They were stuck in a position that was illiquid. And at that point, much like when oil can go to negative 30, it doesn't matter what it's worth or not worth. The reality is a value of an asset that's illiquid can go to any price as long as there is an imbalance of supply and demand. So when you're trading options and derivatives that are long dated, and by the way, 2008 was a similar story. 2008, part of what caused the structural issues we saw is 10-year long-term variance swaps, which are barely traded now because of the crisis that we saw underneath the hood there, went to 60 implied volatility. 10-year implied volatility was priced at 60%. Think about that. 10-year implied volatility. The assumption was that we were going to be at a 60% vol for the next 10 years. Illogical. It's like
60% vol, you're in Bitcoin territory.
Oil going to negative 30. It doesn't make sense. It was a function of liquidation. People were so broken that they had to cover at absurd prices. So long-term derivatives represent a leveraged problem in a liquid market. Zero DT doesn't have that problem. Zero DT, you put them on today, they're gone tomorrow, right? And if the market crashes because of something, guess what? The next day, nobody's going to sell it because they don't want to take that risk, right? So that's the positive. Volume moving from longer term to shorter term means there's less liquidity risk past one day, right? Now, let's talk about the risks. The risks are, it's the most powerful moment. The gamma on it is so massive on 0 days to expiration. Never mind 0 days to expiration, 1 hour, 2 hour options, like anything can happen. Like a dramatic move in a very short period of time can create massive losses very quickly. And because it's so concentrated, there is no way to hedge that part of the distribution other than to hedge it with zero DTE. Think of it as the GameStop and meme name issue we saw. What we saw again there is prices, crazy things, absurd things could happen, right? In a very short period of time, because it represented a place on the distribution that a market maker, an entity trying to absorb that risk can't hedge. The only way to hedge GameStop is to hedge it with GameStop. The only way to hedge, these meme names was to hedge it with themselves. They have no correlation to other names.
So just as a reminder to people, like the market makers, the dealers who are selling these options to people, even the zero DTE options, they're not trying to make a directional bet to the market. They're not trying to bet if the market's going to go up and down and take on the other side of your bet. They have to hedge the position. And if the option is longer dated, they can hedge that position with futures or with stock. So if they're selling you a put because you are betting that the market's going to go down, they can go ahead and sell futures or stock against that, so that if the asset does go down, they're making money on the other side and they're staying neutral. When you're in a zero DTE situation, the move is so quick because it's happening within the same day, and the gamma is so high, which is to say your profit is so much higher than you would get if you had held that option for a month, that the only way they could appropriately hedge to stay neutral is that they actually have to sell zero DTEs. Not necessarily the one that you're the strike that you're buying, but maybe a few hours out or what have you. And so they have to use the same acid because it's the only acid that has the gamma profile, the convexity profile that allows them to be neutral. And so they're adding to potentially the illiquidity of the market and to the increase of the price of these zero DTE assets.
Again, a bit of a reach in terms of a metaphor, but a similar idea. Zero DTE, you can only hedge with zero DTE, which creates a loop. I was at the CBOE's risk management conference earlier or late last year in October, and this was a big topic, obviously. And they put the biggest market makers, several of them, on stage for a conversation about zero DTE. And in the last set of questions, a good friend of mine that's a market maker, I won't name him here, is stood up and asked a question. He said, "How in the world do you guys hedge this risk?" And I kind of got quiet. They said, each of them agreed, we hedge them with other zero DTE. So when you see the CBOE come out with, look, it's balanced. The market in zero DTE is very balanced, right? The market makers are flat. Look, consistently. There's not a risk here. There's not an imbalance. It's because they're hedging zero DTE with zero DTE. They have to be balanced. Now, why is that a risk? Because when you're in a loop, in a closed loop where you can't lay off the risk anywhere else, what happens if somebody comes in tomorrow? And we've seen this already. It happened a little earlier this year. There was a relatively small trade that happened in a big block that took all the market makers out of some, near out of the money puts. And what that did is it created a cascade. And we were sitting there very placidly. I forget what the date was, about a month ago, sitting very placidly all day. And the next thing you knew, we were down almost 2% based on one order, because everybody had to go buy back that gamma, and that gamma loop creates a cascade, which can really feed on itself.
Can you imagine that? The markets are down 2% in one day because of one order that swept the books, that bought up a bunch of the options so that they weren't there for when the market makers need to hedge. So then they have to go sell the underlying. Crazy idea. So this is not some pie in the sky thing. This is something that has happened before, has happened multiple times before, and can happen again.
Now imagine a liquid scenario where I come in and I decide, hey, look, this market's vulnerable. I'm going to go buy 5,000 out of the money puts on the offer, above the offer, just take them all. And there's nobody to now provide, other than the market makers themselves who are short, right, liquidity for those same options to buy them back. What does that do? That creates a massive short-term, gamma squeeze in the market. So you can create there's structurally a risk here that you can create a massive squeeze in terms of gamma in a short-term move that can be very dangerous. It accelerates the probability of a one-day crash. The odds of that are much higher now that these are structurally in the market.
All right, so that's what I want to bring up here. This is not coming from me. This is coming from an expert in the space. Cam used to work for a market maker, and he's describing this situation that could occur because of the advent and popularity of zero-dated options. So yesterday we talked about forced sellers and what happens with unemployment rate. Today we're talking about the instrument of our own demise. Something very, very small multiplied again and again with massive gamma. Who knows what happens there? Now, tomorrow, we're going to touch on the subject again in our 4-part series. And tomorrow, we're going to be talking about the Fed and the mechanisms that the market has in order to come to the rescue, whether that's circuit breakers at 77% down, whether that's liquidity being pumped in from the Federal Reserve, whether that is fiscal policy or what have you, money to the rescue. But what happens if that money can't come in time? That's it, folks, for today's Daily Bread. We'll be back tomorrow for even more information. Please like and subscribe, and let us navigate these markets together. Have a great night.